Right, so let's look at the US Federal Reserve. We've just seen the minutes coming out of their last rate setting meeting 3 weeks ago, where they surprised the market by pretty much doing a 180 on that rather hawkish rhetoric they were employing back in December. Did we see anything here to back up that very dovish picture for rates going forward? Well, swings and roundabouts, I'd have to say. It was rather a glass half full kind of situation. So for the rate doves, you'd have to say actually the discussion that the Federal Reserve seemed to be having in and around its balance sheet tightening, or otherwise QT, quantitative tightening, seemed to be rather more expansive than perhaps we'd thought. There does seem to be a discussion about how they can cut back on the amount of tightening they're doing, with a view perhaps to ending it completely by the end of this year. And I think, looking at what was written last night, it seems quite likely to me that in the next Federal Reserve meeting on the 20th of March, we're likely to see some sort of plan being laid out for how they're going to scale back that balance sheet reduction. And that, all other things being equal, is going to be relatively supported for risk markets. And indeed, we have to take this, the view that although markets have taken that quite positively, again from the minutes, it's not entirely clear that the Federal Reserve is convinced that that's the thing that's actually, for instance, caused markets to backtrack in December. On the flip side of this, however, is one of the reasons is the Federal Reserve is quite happy to now talk actively about slowing down QT, slowing down this pace of balance sheet reduction, is this is a means to actually be more effective and efficient in employing interest rate policy. What they're worried about is, as we get a smaller Fed balance sheet, it's likely to perhaps start to introduce a bit of volatility in short-term rates, and that ultimately has an economic cost, and we're getting to that sort of trade-off level now. So I think a lot of people have gone into the minutes over the last 24 hours or so, assuming not only were they going to get this cessation of QT, but we're also going to get no more rate hikes during the course of 2019. And in fact, if you look what's already priced into the market is indeed not only expecting no rate hikes this year, but they're expecting the Federal Reserve to actually start cutting rates in 2020. So I would say overall quite a nuanced performance from the Federal Reserve in terms of my interpretation of these minutes. I think it would be very difficult for the market's discounted stance on US rates to be fully vindicated unless we saw quite a sharp and I think protracted slowdown in US growth. We haven't quite seen that yet. Certainly the forecasts coming out of the economic consensus at the moment for this year seem to be remarkably stable, perhaps a little bit complacent, but we've seen growth forecasts elsewhere in the world, particularly in places such as Europe, fall quite dramatically in recent months. So I'm not really sure we'd be entirely sensible to take rate hikes off the table. Certainly my view is that we'll probably see one rate hike at least from the Federal Reserve during the course of 2019, and obviously that has implications for the dollar, which has traded pretty steadily thus far this year. Forecast is for a steady decline against most major currencies. Not necessarily sure that's going to play out if we have a rather more hawkish outlook on rates, as indeed I suspect at this point in time.